All right, why don't we go ahead and get started? So thank you very much for joining. We're going to talk about tax today a little bit. Exciting topic, but a very important topic. But first, anything you hear today is general advice, so I don't know anything about you. So I obviously can't offer personal advice, but questions and comments are appreciated. You can leave them in the Q&A. You can also leave them in the chat. One more thing, we are a little bit behind in terms of getting the last two session recordings up. Just a bottleneck we have, but we will get those available. I know a couple of people have emailed about them, and we will we'll get those out as soon as possible. All right, so we're going to talk about tax today as part of our end of financial year run-up. And tax is probably something that is overlooked too often by investors, but can have a really, really profound impact on the returns you get. So of course, when we go out there and we hear about returns, so whether we're looking at overall market returns, I'm not audible. Can other people hear me? Hopefully. Oh, okay, other people can hear me. So not sure what is going on. Maybe it's just a audio issue that you have, Neha. So sorry about that. But anyway, we hear, as I was saying, we hear a lot about overall returns that we receive from the market. We, of course, hear about the returns of different investments that we make. And all of those returns that we get are missing a couple different components. So the first thing they're obviously missing is they're missing any sort of impact from inflation. And they're also missing actual returns that you get as an investor, which include things like transaction costs, of course, fees, and then tax. So why do we care about all of this? Because, of course, as investors, what we are looking for is we're looking at the return that we get from our money. So that includes inflation, because obviously what we're trying to do by investing is we are trying to increase the purchasing power that we have in the future. And of course, we don't hear about transaction costs and taxes. So put a little bit of an example in here. I used S&P 500 returns. Obviously, this applies to anything, but I went back the last 10 years and I looked at the annual return received on the S&P 500, so the 500 biggest shares in the US that you can see here. Well, if we were able to invest in this index and we were not taking inflation into account and we were not paying any fees and we were not paying any transaction costs, we can see that if we invested $10,000, and this is a stat that you see all the time, we invested $10,000 in the S&P 500 10 years ago, we would have $26,921. And that's a total return of 169%, which is really good. And these, of course, are these headline returns that we expect that we're going to receive as investors. But we're going to talk about tax today. So I did a little bit of a calculation where I looked at the following. So I imagined an investor that received this return, they received the market return, and in this case, they happen to incur capital gains every single year and incur short-term capital gains. So very simply, a short-term capital gain is, of course, holding an asset for less than a year. And so I wanted to use a bit of an extreme example. So I decided short-term capital gain. So basically, let's say you wake up on January 1st, or whatever the first trading day is of every year, you buy an index fund. Somehow you are not paying transaction fees or any sort of management fee, so expense to actually get exposure to that. And then you happen to sell right as the market closes on December 31st of that same year. So of course, this is a short-term capital gain because you have not held this for over a year. I also assumed, because I wanted this to be a little bit extreme, that you're paying a 45% marginal tax rate. So we'll show the marginal rates on the next slide, but basically this means that you make more than $180,000 a year. And then, of course, any gains that you get on this would be taxed at that marginal tax rate. Well, if that happened, and once again, I know this is an extreme example, but if this happened, you would have, instead of $26,000, you'd have $16,619. And you would have a capital gain carry forward loss, so basically that you could apply in future years based on that 2022 loss in the S&P 500 of $1,800. But not counting that carry forward loss that you have, you would have received a total return of 69%. So once again, this is extreme, but that is well less than half of the total return. So the point of this, of course, is that taxes matter. And I think we all know that intuitively, but we probably don't spend enough time thinking about it. So let's run through an example. And this is a very basic example. And I think, once again, people probably intuitively know this. But let's just look at a simple example where you go out there and you purchase shares for $5,000 and then you sell them for $10,000. And we're not including any transaction costs in this. So we can see the different tax brackets we have down here in this first column. And you can see what your tax rate is, your marginal tax rate at each one of these different points. And so looking at this investment, so $5,000, you get $10,000, you of course get a total return of 100%. So this is really good. I think all of us would probably take this from this investment. But let's look at the actual taxes you pay. So if it's short-term capital gains, once again, you hold this for less than a year, and we're assuming no income gets produced by this investment for the purpose of this chart, you can see how much you would pay in taxes depending upon your tax bracket on each one of these investments. And what you can see is, even though it's 100% total return, we can see that the return that you actually get, your after-tax return, which is really important to you, slowly drops all the way to a low of 55%. So you're losing almost half your return there. And then if we go long-term capital gains, so you've held this investment, so I haven't put a time period on here, but you held this investment for more than a year, you can see that you do get that long-term 50% discount on the capital gains you pay for holding this long-term. But you can still see that we, of course, are losing money in every single one of these marginal tax rates down to this low of 77.5%. So once again, just an illustration that taxes actually matter, and they're going to impact the return you get. And obviously, taxes are the costs that we pay to live in the country we live in, the society we live in, and pay for all sorts of important things. But as investors, we do want to minimize those taxes that we pay, because of course, what we're trying to do is get a higher return there. So we're going to talk about some different ways you can do it. And we'll spend a couple minutes okay, good question from Daniel. We'll spend a couple minutes talking about different things you can do to reduce your tax bill, hopefully. So Daniel says, managed fund question. Is the unit cost and performance net of all fees, including capital gains tax from their trades, et cetera? So a managed fund that trades more often would incur more capital gains tax and therefore would take a performance hit. Yes. So let's break down this question. We'll talk a little bit about capital gains in funds and ETFs, because they both are exactly the same. So basically, if a fund or an ETF, if the manager decides, or if the index they're tracking changes, if there is a transaction that's involved within that underlying portfolio, and it is a share that is being sold for more than what it was purchased for in the fund and ETF, you do get a capital gain. Now, that capital gain is distributed to you. So those distributions you get from funds and ETFs are not dividends. They're called distributions for a reason, and they're called distributions because they include both the income that those investments generated and the capital gain. So that capital gain gets distributed to you, and you pay taxes on that capital gain. It gets distributed in the same period it occurs, so the same year that it occurs, and you will pay taxes on that when you file your tax return. So no, none of the cost of capital gains is actually going to be included in any of the performance of the fund. And part of this is, of course, because we all pay different taxes based on, of course, the tax bracket that we're in. So they cannot add that calculation because they don't know anything about you. But yes, those taxes that you owe on that distribution, of course, will reduce your return. So if we look at any fund or ETF performance, just like when I looked at indexes there, that performance will include fees. So it will include the fees that you are paying to that ETF or fund, but it won't include any taxes. So we can think of those as pre-tax returns, not the returns we actually get as investors after tax. So hopefully that answered your question, Daniel. So you will take a performance hit. All right, so what can we do to minimize the taxes that we actually have to pay? Well, let's look at some high-level things, and we'll get into a couple structures that we're going to talk about today. So what are the ways that you can reduce your tax burden? Well, number one is, of course, we can take advantage of superannuation to reduce our overall tax burden. So when we look at superannuation, we, of course, are getting a tax break. And we're getting a tax break potentially in two different places. So number one, when we are still accumulating assets, so when we are still working, we get a tax break because the taxes on superannuation are lower than marginal tax rates. So they're 15%. So we go in there and start looking at this, even if we're in this tax bracket right here, this 19% marginal rate, we are still paying less than that. So we're still paying 15%. Now, obviously, there's new legislation out there that this will increase if you have over $3 million in your self-managed super fund. But let's just ignore that for now. You will get a tax break. And even that 30% tax you're paying is cheaper than this tax bracket from 45 to 120. So that's one thing we can do. So, of course, it is maxing out the amount of assets that go into our superannuation. So that 15% that you will pay will be the 15% that you will pay for capital gains and the 15% that you will pay for any income generated by that superannuation. So that's one thing. The other thing is, of course, when we get into the pension phase, most people, when they're in the pension phase, will pay 0% tax. So if you simply hold off and don't sell anything until you get into that pension phase, and of course the taxes drop even more. So if we think about superannuation, and there's lots of different ways to structure a retirement account like superannuation in terms of when you pay those taxes. But in Australia, pretty simply, we are going to pay taxes when money goes in. All right, so when we earn it and it goes into your superannuation, we are not going to pay tax, and we're going to pay taxes over the life of that superannuation on income generated and capital gains, but we are not going to pay taxes when it comes out. So this is the way Australia has structured super. Now, a couple things, that's not the only way to do it. So there are different approaches to this. A very simple example in the US, there's kind of two different retirement tax structures. One, which is a 401k or an IRA. You are not paying taxes when your money goes in, you're paying taxes when it comes out. It's considered income, even if you are in retirement. And then if we look at a Roth IRA or Roth 401k, and this is just an example of the ways different countries have structured tax around this, you pay full taxes when it goes in, so you get taxed at your marginal tax rate, and you pay no taxes when it comes out. Now, the thing about super and the thing about any retirement program like super is, of course, there is nothing to prevent the government from changing the tax rules on you. And, you know, there's obviously been some debate around this $3 million super tax threshold, basically to raise your taxes. There's been a lot of debate about it, but we should be very clear that this is a choice by the government, and that choice can, of course, change, and any part of it can change. So any part of it can change in terms of this 0% that we pay when we take things out from a pension standpoint. This 15% can, of course, change, just like we're seeing that change right now around that $3 million threshold that they have in super. So it is one important thing to think about, and especially something important to think about. We've talked about debt a lot, or we've written some articles, done some podcasts on the massive amount of debt that governments and companies and everyone else has built up since the GFC. So we should always keep that in mind, that of course, where do governments go for taxes? Well, they need to go where the money is. And in Australia, a huge amount of money is in super. So just one thing to think about, but we're talking about current tax regulations. Another thing you can do to reduce your overall tax burden is to be very thoughtful around where you put different assets. So basically this idea of asset placement. And the simple example of an asset placement is that if you had shares and you had cash and you're trying to figure out where to hold them, well, of course you'd want to put shares that have higher future expected returns into something like super, where the taxes are less, as opposed to cash, where you're getting lower returns, where you might want to put that outside of super. So it is important to think about where we hold assets and how we actually accumulate assets. So something important to think about. The next bullet point: minimizing and eliminating poor investor behavior. So I'm calling poor investor behavior here, I am calling that, of course, short-term trading. And you can see that there is a huge, as we went over on this previous slide, there's a huge advantage to holding assets for over a year. It's outside of super, right? And the huge advantage is simply the fact that we do get that capital gains discount for holding something longer than a year. And I would argue that there really aren't many reasons why a long-term investor would want to hold an asset, except in very rare circumstances, would want to hold an asset for less than a year. Of course, we want to be long-term investors. And even though we're just talking about tax outcomes, there are other costs associated with trading a lot. So one, obviously, transaction fees. The more you trade, the higher the fees you pay. And that's dependent upon the broker you use. But you are paying, at the very least, more in bid-ask spreads that you're going to pay every time there's a transaction. So we want to limit that behavior, and we want to make sure that we're investing in things that we do want to hold for long periods of time. So think about how you can do that. Last bullet point. There are some alternative tax structures outside of super that you could potentially consider if they are appropriate for you. And we'll spend a couple minutes talking about those today. But we do, I guess the message from this whole sort of opening of these slides is we do want to be very, very thoughtful about tax. I think it's something that a lot of investors don't think about. They're too busy thinking the way to become a great investor is to focus on picking the right investments. And while that is important, there are other things like tax that can lead to really poor outcomes, and the actual outcomes that we care about, as in how much can we grow our portfolio, grow our wealth over time. So tax is a really critical component of that. All right, so let's talk about a couple of these, and we'll start talking about a trust. So what is a trust? Very simple explanation. So basically, a trust is something you would set up to hold assets for the benefit of your beneficiaries. So basically, this is a legal structure that we can use that can potentially benefit us from a tax perspective. And I'll go through an example of how it can benefit. So why would we use a trust structure? Well, one thing is it can help us with redistributing income from these assets. Now, these assets, of course, could be investments. These assets could be a business that you own. All sorts of different things can be put in a trust, but it can help with that redistribution, particularly when you're doing that to multiple people. And there are a lot of family trusts that are set up. And this basically means that we can distribute income to a group of beneficiaries that may have, and this is why you would set one up, that do have lower marginal tax rates. And we'll use an example if this is confusing. There also are other beneficiaries of using a trust, of course, that we can shield the assets within the trust from any claims against those assets. So very simply, if somebody goes after your business, goes after you, this is a way to shield assets from it. And important in all this is what it costs to set up trusts. Now, obviously, this is very dependent on who you use to do this, and also very dependent upon the complexity involved. And I just went on the internet, so this is no great insight, and looked at what generally it costs to set up a trust. There are some legal fees and some different fees that you need to pay, including a small stamp duty fee that varies among different states that you need to pay in order to set up a trust. So how would this actually work? And who could this benefit? So we're going to use that exact same example. So in this case, you purchased shares for $5,000, you sold them for $10,000, but they're sitting in a trust and get 100% return again. And I'm assuming you've held these things for longer than a year. Now, this is a case, of course, where you set up a family trust. So I don't know, try to come up with a pretty typical family of 2 high-earning parents. So we've got parent 1 and parent 2, and we have 45% marginal tax rate. So I said high earning, so they're all making above $180,000 a year, but they have 2 children. And the children do not have jobs. So I'm assuming they're just children, but maybe they're just deadbeat older children who don't have jobs and are living off their parents. Both of them sit in this 0% marginal tax rate. So the same thing happens. And this trust is set up with these 4 beneficiaries, and it's been set up in the trust documentation that all the beneficiaries, all 4 of them, will benefit equally and will get proceeds from the trust distributed equally to each of them. So that means for each person in this family trust, there are $2,500 in proceeds of this $10,000 sale. And there's a capital gain of $1,250 for each beneficiary. All right, so what are we paying in taxes? Well, based on a marginal tax rate, we're paying $281 for both the parents, right? Because they're sitting in that highest tax bracket. But the children are not making enough to get out of that lowest tax bracket. So they're paying $0 in capital gains taxes. So there we go. Pretty good. What are we paying in total taxes? Well, we're paying $562 as a family for those taxes. So our total return now is 88.75%, which is better than the 77.5% return if the shares are held in their name. So let's see, we've got a lot of questions in chat. Okay, so Daniel's saying, who actually sets up a trust? Where do I actually go to talk about getting one up and running? So you can go talk to, of course, a lawyer about that. You can do it online. There are some legal services online that allow you to set up a trust. You can talk to your accountant about it. So it kind of depends whoever you are using from a service provider perspective and who you want to use. So, very simply, I would say the internet has a lot of information on this. So you can certainly go on there and very easily find somebody that can set up your trust. We have a lot of things in the chat as well. So let me quickly go through those. Oh, lots of things about how they can hear me. So thank you, everyone who said that. Don't trade too much. So we have a question going back. So Manny says, what is the impact of taxes on investment returns in a self-managed super fund? So a self-managed super fund is just a super fund at the end of the day. So, with a self-managed super fund, there is more flexibility, I guess, in terms of different investment options, and certainly more flexibility as you get into the pension period, but the tax outcomes are exactly the same. So you still pay the same taxes that we talked about with a self-managed super fund. So it's kind of up to you to manage those. Daniel saying government changes rules periodically, which we got to. Yep, Grant's talking about. I think everyone's pretty interested in this whole $3 million thing. Of course, the issue with the $3 million thing is that also will include some unrealized capital gains, but we're still waiting for detail from the government on how exactly this will work. Yeah, so Daniel's putting an example out there. So one of the problems is that with this this $3 million cap is, of course, the government can't sit there and say, okay, well, it only counts for realized capital gains. So they're actually looking at unrealized capital gains. But the point is, we don't exactly know how that's going to work yet. We're still waiting for more detail on that. But what Daniel does say is he's talking about, and one of the groups that has raised a lot of concerns about this is people that are actually holding property, businesses, farms, things like that, I guess farms, property, things like that within their super, and they actually can't cover those taxes without, of course, selling the farm, for example. So that has been a concern that's been raised. Let's see, sorry. So Phil says cash has some advantages. When most super funds went backwards last financial year, I had a cash bucket in my account, which actually had a better return than the other investments. Yes, cash does have advantages, certainly in down markets. I think people are mostly talking to each other. So Julie says, what about the ongoing costs for trusts? What are those? You need to conduct audits, use an accountant. Well, the thing that you do need to do is you need to file a tax return. So the trust actually needs to file a tax return. So depending upon how that's done, there could be ongoing costs associated with that. So yeah, Karen's saying the same thing. Trust needs to be clear on trust distribution, but it's still a good vehicle to manage taxes. Yeah, so you do need to file that tax return. So if you were using an accountant, it's an extra tax return. So there would be a cost. And Karen brings up a couple important points in this. So when you set up a trust, you do need to establish a trustee. So basically the trustee is the person in the family or someone you hire. You can hire a third party, and this would obviously have ongoing costs. You can hire a third party that is the trustee. And the trustee is basically making decisions around what is happening with this in terms of distributions. And generally those decisions are documented in the trust documentation. So a simple decision is that in this case, we are distributing an equal amount to every single person in the trust. You could, of course, put conditions around that. You, of course, could say, I like child one better than child two, so child one gets more than child two. All sorts of things like that that could be set up in that trust documentation, and then the trustee would need to follow that. But you can go out there and hire one. So Daniel says kids have a tax rate against them if they earn $420. That math may not stack up. I mean, it depends upon how much the kid earns, right? If you are a child that does not break any one of those tax thresholds, then I do not believe they would pay any taxes. So Mick says, isn't the capital gain $5,000, hence $2,500 per beneficiary? No, because remember, it's $5,000 for the trust is the capital gain. So these shares are held within the trust. The trust has made $5,000 in this, but the trust has 4 beneficiaries associated with it. So that $5,000 gain gets distributed between the 4 beneficiaries. So what we actually do is we go in there and we divide that $5,000 capital gain that was made under the underlying shares held in the trust. We divide that by the beneficiaries. So I just divided that by 4 because that's what you're getting out of the trust is the ability to distribute to the 4 people that are actually in it, rather than what would generally happen is the shares would be held in somebody's name and they would be distributed to them. So hopefully that helped. So Phil says, does super fund pay tax on your investment earnings while you're in the accumulation phase? Yes, it does. So while you're accumulating assets, you still have to pay taxes on income that's earned in that super, and you have to pay taxes on any capital gains distributed. And I think we talked about this a couple of weeks ago. It's an important consideration around super funds, and particularly an important consideration around when you're going to switch super funds. So, the example that we used, I think it was last week when we were talking about self-managed super funds, we were talking about that, on a surface level, if we're thinking about when we'd want to establish a self-managed super fund, what we would normally do is we'd sit there and we look at the costs. Right. So for a self-managed super fund, generally those costs are fixed. Whereas when we are using a industry super, for example, generally the costs are not fixed. And so when you get in a situation where you have costs that are based on the asset levels you carry, which is what you're getting in an industry super fund, at a certain point, you will have enough money in there where the fees that you're paying exceed the actual fees that you're paying into a self-managed super fund. And so, conventional wisdom is, well, if we're interested in that, and we're interested in managing our own investments, we just have to wait till we get to a certain tax level where we have, a certain portfolio size within our super where those fees exceed. But just remember, when you switch, you're switching from an industry fund into a self-managed super fund, the considerations you will have to pay taxes because you will have to sell out of everything you own and then move that money into a self-managed super fund. So yes, you do pay taxes when you're in the accumulation phase. So it's just another consideration that we have to think about with super if we're trying to switch into a self-managed super fund, or if we're just changing super funds in general. It's something that we need to think about, because if I'm going from one industry fund to another industry fund, I need to sell everything before that money gets transferred, and there will be a tax hit. So it's kind of thinking about the timing of when you might want to make that switch. So a good time to do that, of course, would be to do that after the market's fallen a lot, because hopefully that would minimize your taxes. Let's see, what else do we have? I think we're just talking about, so Manny says in self-managed super fund, capital gains tax reduction is not 50% after keeping for more than 1 year. But very simply, you are paying a lot lower taxes. All right, so remember, you are paying 15% versus what you would be paying basically in almost every one of those marginal tax rates. So yes, it seems like Mark is answering most of the questions here. Well, that's good for me. All right, so setting up a trust is one option that you can do. The other thing you can do, and I am obviously not a tax professional, so you should talk to a tax professional if you are considering any of this. There are some structures with trusts where you can combine a trust and a company as well, and there's different rules associated around that as well. So something to think about. The other option is, and we're going to publish an article on this that provides a little more detail tomorrow. The other option is that you can actually set up a company. So a company is a distinct and separate entity, so a little bit different than a trust. But what you can do there is you can hold assets within this company. And potentially, this is an opportunity where you can also reduce your tax rate if, of course, you meet these two different criteria right here. So $50 million, which should be, well, I don't want to talk about any of your personal situations, but most investors should be able to get by with that. But then, of course, 80% or less of the company's accessible income for the year is passive income. So this would be a situation where you do own your own business and you also want to hold some assets in there. So remember, passive income is what we're all hoping to get as investors, but we just need to make sure that that passive income does not exceed the 20% mark for setting up a company. So, in conclusion, we're getting lots of comments still, but once again, they're mostly getting many comments answering the questions in here, which is good. But really what I wanted to talk about today, more than just kind of those simple legal structures that we have, is really talk about the considerations that we need to think about with all investors around tax. And that it is a really important component of this. And there are certain mistakes that we can make as investors, and certainly certain tax laws that we can take advantage of. So it is something that's really important to consider. And if your situation is something where it is advantageous to consider something like a trust, think about the different family members, different tax rates over time. And certainly I used a very simple example where both spouses were in the same tax bracket, but that's another consideration, of course, for people to think about if potentially your spouse does not work, if there are even different tax rates between you as you get older, spend more time in your career and potentially dial back a little bit and are working part-time. There's all sorts of different considerations where you can lower the overall tax that you will have to pay as a family. So trusts are popular with certain people that do meet this criteria. But really what we need to think about, investors, is all the different ways that we can minimize our tax burden. And just remember that this is something that we never see when we're talking about performance fees. We never see when we're looking at any example like the one that I used, where what could $10,000 turn into if you were actually investing in something. So that's really what I wanted to cover today. As I said, I am certainly not a tax professional, but just wanted to let people know about some of these different structures that you can set up, just so there's awareness out there. And certainly talk to your accountant, talk to a lawyer, figure out exactly what the different tax rules that may benefit you as an investor. But the simple one for all of us is, of course, super. And getting as many assets as possible into super, thinking about where we hold different assets between assets are most likely to have worse tax incomes, where you're going to make more income off of them, where there's going to be more capital gains generated, and then things like cash, lower performing assets that are really important things for people to hold as far as their overall financial plan, but could be better served sitting outside of super. And finally, of course, most important thing is to not create poor tax outcomes by having poor investor behavior by trading a lot. So just remember, the more you trade, the worse your after tax, after fee, after transaction gains are going to be in your portfolio. So something that everyone can deal with. So a little bit of a shorter one today. But once again, if you have any questions, just email me at mark.lamonica1@morningstar.com. And then finally, we will get the recordings up. So sorry about the backlog if people missed the last couple. We did spend a lot of time talking about self-managed super funds. So hope everyone has a great Tuesday.
This video has been prepared for clients of Morningstar Australasia Proprietary Limited and or New Zealand wholesale clients of Morningstar Research Limited. Any general advice has been provided without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.